Stocks surging after the United States says it will delay China tariffs on some products until December 15th. Those items include cell phones and clothing, among others. Let's discuss how this affects the ETF market with Kevin Carter, founder of EMQQ, Emerging Market Internet ETF, which has significant exposure in both China. And I wanted to ask you, what's your exposure in Hong Kong, too? But first of all, your reaction to the news that the trade representatives will now look at these products that 10% tariffs were supposed to go into at the beginning of the month, now delayed in large part until December. And what does that do to the stocks in your ETF?
Well, any delay in the tariffs, I think, is a good thing. I mean, tariffs are mathematically, and there's a great consensus to this, tariffs are not a good thing. They're a tax, essentially, on the people that consume the end product. So any delay to the tariff regime, I think, is a good idea, and I'd like to think it's just a negotiating tactic. In terms of effect on EMQQ and the e-commerce companies, you know, we're not really involved with the trade war. I mean, the trade war is about agricultural products. It's about manufactured goods. And, you know, the real story in China and emerging markets is the growth of the consumer. And it's a consumer with a smartphone in their pocket, and they're doing everything online. And that's a secular, sort of one-directional thing.
You have, among your top 10 holdings, Tencent, Alibaba, Baidu, you have JD.com. Give me a sense of how much of their future success relies on better trade relations with the United States.
Well, I mean, at the heart of the trade conflict is the idea that China doesn't consume enough and it manufactures and exports too much. And China knows this, and the government's been working to rebalance their economy towards consumption. So to the extent that that rebalancing increases consumption, I think all of those companies benefit. I mean, this is really the story. It's all about the consumer. Emerging markets, the thing that's emerging are the people. They're moving on up. They want stuff, more and better food, clothing, appliances. And China, India, wherever it is, that's the story. And that's really at the heart of our trade conflict. What needs to happen is China's consumers need to consume more. And I think that those stocks are well positioned to help them do that.
How much of your ETF is focused on Hong Kong?
Well, you know, 60% is China. Chinese stocks trade in Hong Kong. They trade in the U.S. And also in Shanghai. But the companies we own are largely in the U.S. Tencent, of course, trades in Hong Kong. What's happening in Hong Kong affects China and it affects the world. But I don't think the stocks that trade in Hong Kong necessarily behave or should be thought of differently as the Chinese stocks that trade on the New York Stock Exchange.
Do you think that there are implications, though, for the way that China handles or does not handle these ongoing protests for the companies that are in your ETF?
I think it certainly handles this. It influences the sentiment. I mean, look, there's riots in the streets of Hong Kong. The situation with the handover of Hong Kong back to China has always been an area with some stress involved. And right now, some of that stress is boiling up. And it's certainly important to the sentiment. I don't know that, you know, how it resolves itself affects the fundamentals necessarily, but it certainly will affect sentiment. And we'll have to see what happens with it.
Finally, where does the calculus lie now with from China's point of view? You said they've taken the gloves off. We see them using the yuan more aggressively now. What are they thinking today when they see what appears to be sensitivity on our part, the U.S.'s part, regarding equity prices?
Well, look, tariffs are a bad idea. I mean, I can't stress this enough. This is a point that I learned very clearly in college, and it's, you know, mathematically. You know, we had a trade scuffle with China 10 years ago regarding tires, and the mathematics of it have been studied, and they're a bad thing. Universally, I think, believed by most economists. I'd like to think that our government's threat of these tariffs is just a negotiating tactic, and that eventually, and hopefully soon, there'll be some resolution that doesn't involve tariffs. I'm not saying that there's not room for us to position our trade deals better, But tariffs are not a good idea, and I'm hopeful that, you know, that whatever news is out this morning that's favorable is something that'll continue.